You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got Bilal Hafeez. He's the founder of MacroHive, which is a platform that discusses, macroeconomic investment views from crypto to equities to macro, as he says in his Twitter bio. And so, previously he was working at big banks, running the FX and Rates Research departments at places like Nomura, Deutsche, JP Morgan. And, Bilal, thank you so much for being on the podcast. It is awesome to have you here.
No, my pleasure. Thanks for inviting me on.
Yep. Well, I'm a huge fan of your podcast. And so I guess we should start off there. So, one, could you tell the audience a little bit about your background and your career? So, you started off in the big banks, and then could you talk a bit about, the transition from, being a big bank strategist to, founding MacroHive?
Yeah, of course. Yeah. I mean, if we just kind of go back to the beginning almost, I studied economics at university. This was back in the late 1990s, and I did economics. So obviously that naturally would lead to a career in finance. I did economics at Cambridge, and at the time, all the big banks would come to recruit from Cambridge. So that was kind of my initial exposure to finance. I always had a view that I wanted to do something. Something either in finance or management consulting, something in those areas. And finance ended up being the place I ended up having most luck with. So I applied for lots of different jobs as an intern, and JP Morgan ended up giving me a summer internship. And so that was my sort of first exposure to banking. And then I liked it as soon as I got into it. And so early on, ended up working for JP Morgan in foreign exchange research on the research side, and really, really enjoyed it. What helped was I had a really good first boss, a chap called Alfonso Prakash, Argentinian guy, who later went on to become the central bank governor of Argentina and the finance minister of Argentina. So he's quite an impressive character, but he really influenced me a lot and gave me a lot of confidence in what I was doing. And he kind of set the groundwork in terms of how I looked at markets and my sort of skills and so on. So I was doing research early on at JP Morgan, and then I left JP Morgan in 2002 to join Deutsche Bank, where I had a long career there, about 13, 14 years. And back in the 2000s, before the global financial crisis, that was kind of the boom time for the financial sector. And Deutsche Bank was the powerhouse in fixed income. It grew dramatically, ended up becoming probably the biggest or one of the biggest fixed income shops in the world, up there with JP and Goldman's. So I joined them, ran foreign exchange research for a long stretch of time. Then after the global financial crisis, things changed a lot in finance, as you can probably tell from other people you've spoken to. So that was a massive sort of structural break in the industry, where before that there was not much regulation, there was a lot of innovation. You could do lots of stuff, anything you wanted, you could kind of do, which has its good and bad side. The bad side obviously led to the financial crisis. But then soon after the global financial crisis, things changed a lot. Massive amounts of regulation, all sorts of constraints on what you could do, limitations on who you could interact with, and a general risk aversion, I would say, within the financial sector. So from before the global financial crisis, it was like, if it's innovative, do it. After the financial crisis, it was more like, if you want to do something new, don't. Just keep everything sort of steady. So during that phase, initially I moved to Asia for a few years because I thought Asia would be much more of an interesting area. It was a growth area. China was really doing well. So I spent a few years out there, where I ran Asia research. Had a great time, really liked it a lot. But in the end, for personal reasons, family, friends, my wife and kids, we all wanted to kind of come back to London, which is our home. So we ended up coming back. And then I took on a new role at Deutsche Bank, where I ran cross-market research. And I also had an additional role where I was doing research with the CEO of Deutsche Bank, who's Anshu Jain at the time. So I did that for a few years, and then I thought it's time to move on to do something else. And I was at that point, I was toying with the idea of launching my own company because I had this entrepreneurial spirit within me. But I thought, let me kind of try something in banks before I do that. So I moved to Nomura, Japanese investment bank, which was kind of not in kind of the top tier, you could say, at least not in Europe and the US, but it wasn't as regulated as some of the other banks. It was a pure investment bank. It didn't have any retail exposure. So in some ways, it was a bit more, it was more of a risk taker as an institution than other places. Right. So I moved to Nomura, ran research there for about 3-4 years. But in the end, I realized, look, there's only so much you can do within a bank. In the end, there's just all this institutional inertia. And so it was time for me to strike out on my own. So that was kind of the background to launching MacroHive. And in terms of the transition, it was a lot less hard than I thought, to be honest, because one, it does help you if you already have a reputation in the market. So I already had a name in the market. And so that, makes it easier for people to recognize you when you launch a business, to get clients and so on. But also, you also have built up a huge network. And so you can lean on your network to help you out during the startup phase. And if you look at statistics on business startups, the most common age for a startup are the 40-somethings. There's this kind of myth that, startups are a young person's game, where people who are 18 or 19 or 20 do a startup in their garage. Obviously there's high profile examples of that, but in general, it's people in their 40s who do startups. And those are the ones that tend to be more successful as well. So that was kind of some of the background to making that transition.
And so, at the start, you said that, you did economics at Cambridge. And so, that was sort of the back end of when economics was, and you said it was in the 1990s. So that was sort of the back end of when economics was still taught as a philosophical subject, as opposed to the way it's taught today with a lot of mathematics and quantitative methodology. And so, one, do you think that the value of university education in economics has gone down, relative to, say, the 80s and the 90s, because they used to teach you how to think versus now where they just teach you various econometric models? And two, do you think the value of, say, working at a bank has gone down post GFC, post all the regulation? They've shut down the prop desk, the banks are a lot, as you mentioned, a lot of these banks are more limited in what they can do. And so what's your take on that?
No, I mean, the really good questions. In terms of the changing nature of economics, it certainly is true that economics has become a lot more quantitative as the years have gone on. In fact, when I was doing my degree, I kind of leaned more on the technical side, econometrics and so on, but there's still lots of options to do some of the more kind of qualitative areas. I do think there is a loss in getting rid of that side of economics. And I think, as you rightly point out, one of the advantages of that philosophical way of thinking, and also kind of a historical of the humanities way of thinking, is that it allows you to, number one, deal with inaccurate or imprecise data. So often, especially in markets, you don't have data for everything, So while we talk about big data and everything, often the value that you have in markets is information that's not easily quantified. So, and this is especially the case when you get these sort of structural breaks in markets. So to have that mindset of how do you think about your process of coming up with things. So it's almost like understanding first principles, you could say. If you lean too much towards the technical side, you can almost become a slave to data. And I think often the way people are taught econometrics and data science, it's almost like people don't really understand what they're doing. They don't, and so I think there is a loss there. I also think that since the global financial crisis, there's been lots of events that have happened where the recent past, i.e. the last 20, 30, 40 years, aren't the right reference points. You have to go even further back, to either the interwar period or, world war periods, or even earlier pandemics and so on. So that requires you to have kind of a historical mindset. And then when you go deeper into history, you have to have knowledge of that historical period. How can you compare it to today, where, what's the similarities and differences? So I do agree. I think there is a loss. At the same time, I do think that the technical skills you pick up today in economics are very powerful. And a lot of the work you do in markets, it really does help you to have those quantitative tools.
Yeah, no, and I completely agree, because as you mentioned, a lot of the edges end up being qualitative as opposed to quantitative, and so the quantitative ones tend to, while they exist, they either tend to be arbed out by a lot of these, larger quantitative hedge funds, which tend to get to those ideas faster than you do, and so so moving on, I wanted to start off by talking about what's going on right now. Everyone's eyes are on the whole Russia-Ukraine situation, and so what's your take on it, and how are you thinking about that, especially in terms of market dynamics and implications for capital markets as a whole?
Yeah, of course. Yeah, I mean, obviously, what we're seeing in Ukraine, Russia is all quite dramatic and quite shocking. And obviously, we won't be talking about the political or moral dimensions of what this all. We'll talk about this purely in economic and financial market terms. The few observations I would make are that, number one, in the grand scheme of things, Russia is not the same as China, in the sense that Russia is not a huge economy in the world. So, if Russia was to slow down dramatically, it wouldn't really have a huge impact on global growth. The real way Russia has an impact on the rest of the world is through energy. And so that's the first point I'd kind of make. And I think that when people look at the images they see on television, it's easy to paint a picture that this could dramatically upend markets. But we have to understand the transmission mechanism through how it will impact global markets. So obviously, Russian markets themselves have cratered, and that's what you'd expect with the sanctions that we've seen. The real question that all investors are trying to understand now is how much of that will impact the S&P 500 or bond yields or European stocks. How much does it go beyond Russia? And for me, the critical channel is through energy. Obviously, right now we're seeing natural gas prices have shot up dramatically. So there's an obvious channel there, which hits European growth and also European inflation. But the bigger one for me will be if oil prices really go up sharply. Now, they have picked up, over the past few days, but they haven't picked up as much as one would have thought. In some ways, oil prices were already on an uptrend since December. And what we've seen over the past week is slightly faster than the trend, but it's not dramatically so. But for me, the next risk for markets is a more dramatic, rise in oil prices. So that's the risk I'm really focusing a lot on. And the reason for focusing on oil as a risk is that when you look at recessions, whether it's the US or the global economy, most recessions have tended to coincide with large shocks in oil prices. Even the global financial crisis, in the 1 or 2 years before the global financial crisis, we saw a surge in oil prices, which, while it wasn't the only factor, it definitely contributed to why we did see a sharp slowdown thereafter. So for me, that's really the biggest risk for markets overall, that we see a dramatic increase in oil. Now, how could that happen? One way is, at the moment, all the sanctions that the West has imposed on Russia have been on transactions related to non-energy, the non-energy sector. So essentially, there's all these financial sanctions, SWIFT suspension, banks have been sanctioned, the central bank's been sanctioned. But if transactions are related to energy, they're allowed. But the next wave of sanctions could include the energy sector, in which case oil could really, really go higher. But this is a delicate phase, though, because that's where there's pain to the rest of the world. And so the question then is, how can the West deal with a new oil shock if it was to emerge, and if they were the ones to trigger it? So that's loosely the way I'm kind of thinking about it at the moment.
And so, when it comes to Europe, so, you mentioned that, one implication has clearly been a spike in natural gas prices. And so the EU in general is highly dependent on energy supplies from Russia. And so, considering that the ECB made sort of a pivot to hawkishness, so do you think, that would become a policy area in that sense? Because, higher rates would not do anything to counter, imported inflation, most of which comes from Europe's energy supplies are highly dependent on Russia, And so, if they go through the roof and, they're being imported, higher rates simply don't solve that. So, do you agree with that view? And just in general, what's your take on, the hiking cycle in Europe and, how it plays out for the euro?
Yeah, sure. Yeah, I mean, I referenced that period where oil prices rose dramatically before the global financial crisis in 2008, 2006-7, and at that time the ECB was increased interest rates at the time to deal with the higher inflation prices, and that ended up being a terrible decision. And some years later, even during the European crisis, they ended up hiking at one point, when oil prices picked up. So I think the ECB has learned its lessons from the past. And this time around, if you look at its rhetoric over the past 6-7 months, it really has been firmly in the transitory inflation camp, partly because it's been scarred in the past by raising rates off the back of higher energy prices. So I think the ECB is going to be very, very cautious in this environment. Already the market has effectively priced out the hikes for this year. So there's been a big turnaround in ECB rate hike expectations. Before Russia-Ukraine, the market was pricing 1 or 2 hikes by the ECB this year. And now most of those hikes have been priced out, which I think is fair. That said, I do still think the ECB will taper. It's winding down its balance sheet expansion, so I think that will continue. The interesting dynamic, I think, from an ECB perspective, is that how one interesting way they can deal with high energy prices is through a stronger euro. And the question is, how can they engineer a stronger euro? Like, one is taper, which they're already doing. The other would be higher interest rates. So I think there could be an outside chance that they could say, okay, let's raise rates to get a stronger currency. That's not my base case, but that's probably the only way I could think of where they could raise rates in this current environment of higher oil prices, higher gas prices. But in general, I think the ECB is going to be very, very cautious from here onwards.
And so, speaking of hiking, going to the US, so, recently over the last, I guess, couple of days, we've seen the number of implied rate hikes go down. So about a few days ago, I guess, almost right before the Russia conflict, we were the Fed was expected to hike 6 times roughly by December 2022, but then now that's come down to less than 5. And so on my Bloomberg, it says 4.73 at the moment. And so, what's your take on inflation? And are you on the transitory side or are you on the non-transitory side? And so how are you thinking about hiking in the U.S. and sort of the implication for rates and currency markets?
Yeah, I mean, on the inflation side, I'm kind of lean more in terms of on the transitory side, but I think we have to be careful in terms of what we mean by transitory. So what I mean by transitory are the factors that have been causing high inflation, I think will be sort of temporary factors. They're not necessarily structural factors. And the reason I say that is if you look at the inflation, inflation over the last 2-3 years, there's been a number of factors that have caused higher inflation. Number one, there's been the pandemic, which has introduced all sorts of supply chain issues. So because of the pandemic, people haven't been able to work. And as a result, there's been an issue around supplying goods around the world in different ways. And there's been absences from work and so on. So there's a pandemic effect. Then there's the oil effect, that oil prices and energy prices have shot up over the last year or two, which has caused higher inflation as well. Then there's a fiscal response, especially on the US side, where the US actually increased people's incomes over a recessionary period, which is incredibly unusual, which led to a huge acceleration of consumption growth in the US, where you saw in the space of 1 or 2 years, you saw the same amount of consumption growth of goods as you would see in 10 years. So there's this huge positive demand shock that you've seen. And then finally, there's been the central bank easings, which have also contributed to higher inflation as well. So you've had all of these forces that have come together. Now, in terms of which ones of these are permanent? My sense is when the pandemic eases up, a lot of these supply chain issues will start to ease up. The one thing we've all struggled with is the pandemic has lasted longer than we all thought. Only recently, only on this Friday has the US lifted the guidance on people wearing masks indoors. UK is probably the furthest ahead in terms of the Western economies where there's no restrictions. But, in Germany and other countries, there still are restrictions of different kinds. But I do think in the next few months, because of Omicron, there's a growing consensus around the world, even with the Chinese, that this is more like a flu now rather than. So the pandemic's lasted probably a year longer than we all thought. And as a result, it's pushed inflation higher for longer. So for me, that's going to pass, at some point. The other one is the fiscal stimulus that the US did. We know that's passing already. So that's this year, the US will have more of a negative fiscal impulse. So we'll have less of that. Then there's the central bank side, where central banks have been raising or expected to raise rates. So that's less inflationary. The one swing variable here is energy, where it did seem like we've probably seen the worst of the rising energy prices, but now with Russia, Ukraine, that's the thing that could extend the energy cycle, the inflation cycle. And so that turns this into more of a conventional energy shock, type of inflation, which makes it more difficult for central banks to deal with. But what that means in the end is that we're much more likely to see recessionary dynamics unfold. So for me, the more interesting proposition is, while there is still this inflation story, I do think the bigger story is a recession. And that then affects what the Fed will end up doing, because my sense is the Fed will still hike rates early on quite aggressively because they're very sort of sensitive to inflation. But as the year goes on, they'll become more recessionary type signals will start to become more apparent in the US, even in the US. And then that will prevent the Fed to be able to hike rates aggressively. So you end up in this environment where, the market could end up overpricing the hikes right now. But it's partly to do with inflation coming off a bit, but it's also to do with this recessionary dynamic. And oil shocks are really a big part of that now as well.
Yeah, I know the other thing that we're also seeing is the yield curve is flattening. And so, I guess that's another sign of the fact that economic growth is, at least the bond market is expecting it.
Yeah. I mean, this is quite unusual how flat the curve is before the start of a hiking cycle. Typically, the curve doesn't flatten this much. And so markets are kind of telling you that not all is well in the economy. And we've actually built a model which extracts the market probability from the yield curve for recession. So right now, our model that's based on the US yield curve is giving a 40% chance of a US recession, given how flat the curve is right now. At the start of this year, it was around 15%. So it really is sort of shot up.
Yeah, no, 100%. And so I guess the probabilities of, I guess that's in general, one, the initial hiking cycle being, I guess, some sort of a policy mistake considering the other dynamics at play, because as you mentioned, we're also seeing, fiscal stimulus start to roll off. And, with that, fiscal stimulus has been the key variable in driving economic growth and aggregate demand since the start of the pandemic. And so seeing that roll off along with high rates, that's definitely not a recipe for higher growth, at least from what we can see. Yeah. Moving on. So, the other thing that people have been watching, especially with the whole Russia-Ukraine situation, has been ags and, I guess, uranium. And so, those two have been, I guess, core theses. And, a lot of investors have discussed that on your show as well. And so, so what's your take? What are your takes on, I guess, commodities and you're super bullish on crude. So what's your take on, say, uranium, for example? And so that's something that a lot of people have been watching and have been bullish on. And so some things that you're seeing right now are Germany is going to postpone the nuclear phase out, and if anything, they're going to bring back nuclear simply to reduce energy dependence on Russia, for example. So how are you thinking through ags, nuclear, etc.?
Yeah. I mean, I think overall we're in quite a constructive or bullish environment for commodities as a whole. In terms of the specifics, let's start with ags, then we can talk about uranium. On the ag side, this Russia-Ukraine conflict is is really quite dramatic. Russia, Ukraine together, they're one of the largest wheat exporters in the world, also sort of sunflower and some other commodities as well. And so we could see quite dramatic restriction in wheat supply to the rest of the world. Wheat prices have shot up, and that's an important staple for the world. So we are likely to see another leg up in food prices. Now, for me, there's two consequences of that. First, that's a problem more for emerging markets, where food is a larger component of people's consumption baskets, more so than the Western economies. So this is going to be a real problem for emerging market countries if food prices go up, further from where they are right now. And so that's kind of one general observation. The other one is that typically when you see big increases in food prices, you tend to get social unrest. Now, we haven't seen that over the last year or two, even though we've had higher food prices. And I think a big reason for that has been the pandemic, where the pandemic has kept people home. But now, as the pandemic is easing, I think there's a much more higher probability of social unrest in different forms. And so that could actually be another factor for general commodity prices increases, because if you suddenly get social unrest in countries who are commodity exporters in emerging markets, whether it's the Middle East or parts of Africa or Latin America or North Africa, then you could start to see, workers in key sectors not being available to work, and that has an impact on other commodity markets. So that's a few observations on the ag side. So it's definitely one to watch. The other one, in terms of uranium, I do agree there is this, inexorable move towards nuclear. At least if you just look at the numbers, there's essentially no real way of meeting carbon emission standards or requirements without using nuclear of some form. I mean, renewables just don't have the same energy density that you need to be able to meet those guidelines. So in general, that's a bullish, constructive environment for uranium. The issue with uranium itself is that it's a relatively illiquid market, and so the prices can be quite erratic. But the structural case is very bullish for uranium, and especially as the development of these smaller reactors which are safer and easier to build does help the case overall. The one issue with nuclear is there is a quite large upfront cost, so there is an infrastructure issue around doing that all. But I do think that what we're seeing in Germany is potentially quite pivotal. So Olaf Scholz, the Chancellor of Germany, gave what's now called the turning point speech last weekend, where essentially they did a pivot or U-turn on key policies. One was on energy, where they basically brought forward their move towards renewables. They talked about importing more liquid natural gas, LNG, becoming less reliant on Russia. They kind of opened the door to maybe reconsidering nuclear as well. And what's key there is what the Green Party thinks, which they could be open. They pivoted on defense, that Germany now will ratchet up its military spending. And they also were a bit more open to more fiscal spending as well. So there's been a huge shift in Germany around this all. Now, the key thing is, now that everybody's essentially seemingly agrees that Russia is a country that they don't necessarily want to deal with going forward. The question is whether the Green Party in particular would be willing to recognize that they need to go back into nuclear in order to move off nat gas reliance from Russia. So this is an area we need to watch, but I think there's a good chance that we could move in that direction.
Yeah, got it. And so, moving on, from like a general standpoint, you worked as an FX and rate strategist, at the big banks. And so, what are your favorite resources for building, FX and rates trading strategies? Say books, papers, etc. So, how do you go about, building both macro outlooks as well as trading strategies in these markets?
Yeah, no, that's a good question. I mean, my kind of general approach to all of this is to take a fairly holistic approach. So my general approach is to understand the theory. I do think theory is important in finance, and although often the theories are wrong, it's important to have something to fight against or something to use. So I would say that just getting some sort of good textbooks on FX rates, equities, and so on is quite helpful. Now, I'm kind of from an older vintage, so there's a different series of books that I use, but I'm sure, today there are some sort of good books on that. So in FX, it would be things like, understanding concepts like uncovered interest rate parity, which is related to carry trades, understanding what purchasing power parity or PPP is, which is related to currency valuations, and then understanding, say, option theory as well. So those are some of the areas that you need to understand. And then also some of the fundamentals like current account dynamics, balance of payments dynamics, and so on. So in currencies, you have to kind of know that. Then on the rate side, it's important to know what drives the term structure, of a yield curve, what are the different types of instruments, what are cash bonds, what are swaps, does how do you forecast term premium, what is term premium? So you just kind of need to know some of the theories. I think that's quite important, and the same for equities as well. But in the end, I think a lot of the experience you get is one is to kind of implement your views either through trading or through writing. So, to write down what your views are on a given market, and then you can mark to market yourself in some form. And the other thing is just to somehow get hold of other researchers' views, and then through that you'll be able to learn, how they come about, with sort of ideas. Then on terms of the trading strategies, I think there's some well-known sort of trading strategies in all of these markets, but the key ones that you have to understand is first, just at the basic level, understand what trend following strategies are, which in essence is just follow the price momentum. If prices are going up, you buy. And you can make it more complicated by having more complicated mathematical functions, but ultimately that's all you're doing. If price is going up, you buy. If price is going down, you sell. And then there's a lot of thought about, okay, how do you define a price increase? Is it relative to yesterday, the day before? Should you smooth it? There's all sorts of ways to refine it, but ultimately that's a key strategy that almost every investor uses, whether they admit it or not. And then the other one is the carry strategy, where everybody likes to earn carry in some form. So you want to buy the high interest rate markets, sell the low interest rate market. You try to earn the roll yield on the curve, high dividend stocks versus low dividend stocks. And then the third important one is valuation, value-based strategies. Understand, okay, in a given market, how do you determine whether a market is under or overvalued? And then you can build a strategy around that. So almost all quant strategies are based on those three. Quants tend to lean more towards momentum and carry, whereas macro guys, discretionary guys, lean a bit more on value as well. But ultimately, everything kind of goes back to those three. Then you can kind of have more advanced models where you have ad hoc models, which are based on relationships which appear to work right now, and you just hope they're going to carry on working in the next period. You can use machine learning, which has the advantage of being able to make use of larger data sets, and it's also able to look at non-linear relationships in a much more effective way rather than traditional econometrics or techniques. So then you can kind of push into that frontier as well. So I think all of these things are really important to learn, and there's a huge amount to learn, and in the end, you kind of need to do a combination of learning the theory and then some kind of practice as well.
Yep, and and when it comes to FX and rates, so do you have any, I guess, good book book recommendations, for example? So the one thing that you have on the equity side is you have just a ton of books when it comes to equities, and you can find books on, say, Chinese equities. You can find, and you've got the regular, I guess, Peter Lynch, Ben Graham, Warren Buffett, etc., that you can read in order to understand the equity market a lot better. So similarly on the macro side, we don't exactly have those kind of guidebooks. So it ends up being more a holistic approach. And so do you have any good book recommendations when it comes to building FX and rate strategies, or any good papers, etc., that you would recommend?
Yeah, it's a good question. I mean, I think in terms of textbooks, if we start on the FX side, there's a book called The Economics of Exchange Rates by Lucio Sarno and Taylor. That's a very good book. It came out a while ago, about 2002, 2003. But I think a lot of what's written in there still holds today. So I think that's a very good book. The other one is Exchange Rate Forecasting by Michael Rosenberg. I used to actually work with him at Deutsche Bank many years ago. But what he's done very well in that book is that he describes the theory of FX, and then he relates it to what actually happens in FX markets as well. So I think those two books are very good for kind of the theory and how it applies to the real world. So I'd recommend those two books. Then on the rate side, there's a few sort of books that are very good. One is the Fabosi's book on fixed income securities is very good. There's also another rates book by, let me just see if I have it here. Fixed income securities by Tuchman and Serrat is also very good as well. The book on trading strategies that I like a lot is Expected Returns by Ilmanen. So he's worked on the kind of hedge fund side, and also he has kind of a quantitative background. So I think that's very good for learning about sort of trading strategies. Then Systematic Trading by Robert Carver is very good as well. And then I would also say some of the option books, like Nassim Taleb's Dynamic Hedging. That's a bit sort of older now, but that's a good book. Adam Iqbal, who runs Goldman's FX Options, he's come out with a couple of books on FX options, which are very, very good. So that's worth reading on the options side. Then Hull's book on options is also very good as well. On the rate side, aside from textbooks, I think the Fed and central banks produce a lot of good stuff on rates. So if you just go to the Fed website and the working papers, it will often have something around term premia or inflation expectations, and you can learn a lot from some of those papers. And some of them are quite accessible as well. So I would say that's another good source. And the ECB does something similar as well, and the Bank of England. So the central banks academic, their papers are quite good on the rate side and rates inflation. FX is a funny one. FX kind of falls between the cracks. There's a huge amount of literature on rates and equities, but FX always falls between the cracks, because it's kind of an in-between asset class, which for me makes it much more interesting as well.
Yeah. Okay, and then moving on, I wanted to talk a bit about your experience running MacroHive. So you've published many podcast episodes, and your podcast is absolutely wonderful. So who have been, I guess, your favorite people to interview, and what have been the best lessons that you've learned so far?
Yeah, sure. Yeah, so I mean, just if I just give some background first of all on MacroHive itself. So we set up MacroHive a number of years ago in 2019. So I set it up with my partner Andrew Simon, who used to run sales at JP Morgan, FX sales. So he kind of had more of the business side. He also was an option trader by background as well. So we kind of set MacroHive up, and the idea was to provide, insights, research, and so on to a broader audience, which is through the podcast. And we have a website where there's a subscription where retail or just the average person can get access to market views. So we have that product, and then we have a more high-end product for hedge funds and asset managers, which is a much higher price product. And they get access to the full array of everything that we do. So that's kind of the product offering that we have. But philosophically, what we've done is we have our in-house research team of 7, 8, 9 people. But then also what we've done is we've built a large network of other researchers who we collaborate with and interact with, and we kind of harness the intelligence of our network in order to deliver ideas. So that's kind of something about MacroHive itself. And as you mentioned, a big part of this has been our podcast, which is free and available, comes out once a week. And we've been doing this pretty much, I think, for almost 2 years now. We recently passed our 100th episode, which was great. And, I've interviewed all sorts of people, as you know. Now, in terms of which people I've kind of enjoyed the most, I mean, first of all, I have to say, as a host, they've all been fantastic. We've had some really good people. Like we had Raghu Rajan was very good. So he used to be the governor of the RBI and the former World Bank economist. He was really, really quite good. Early on during the COVID period, he laid out a really good framework of how to think about how the COVID pandemic would unfold. Mervyn King was also very good, former Bank of England governor, in terms of thinking about inflation. And he was surprisingly candid about his views on the Fed. He's quite critical of central banks. Charles Goodhart, who's like a real heavyweight in central banking circles, he was really, really quite frank and open as well. Now, outside of that, more on the investor side, I'm just going through the sort of the list of people that we've had. I would say I always enjoy speaking to Jim Leitner. So Jim Leitner we've had on twice. He's actually was our first client as well on the institutional side, for us, and I speak to him every week. He's somebody who's quite unusual in the sense that he kind of he's kind of in the market day in, day out, but he can think very strategically, which is unusual. And he's willing to hold on to trades for longer than other people through the use of options. So I think he's amazing. And, yeah, he's great. Then also let me see. Then I mean, we also had Mark Yusko recently. He was very good. So he's the CIO of Morgan Creek, and again, he was quite thematic, which I liked. He had a view on asset allocation, on crypto. And so I thought he was quite compelling in many of the things he was talking about. Charlie Ellis was another one that was very good. He's a bit of a legend in the investment circles. He was very good. R.E. Paul, he is the CIO and founder of Block Tower Capital, which is a crypto fund. He was in the crypto space. We produce a lot of research on crypto now. And what I find on the crypto space is that you have kind of these two extremes where you have these crypto enthusiasts who basically say that crypto will solve all the problems of the world and they can never see a fault in crypto. And they basically tell you to put all your money into crypto and you're going to become a billionaire, which I think is not quite right. And then the other side, you have the real cynics who think it's all one big scam. Now, Ari's, someone on, who sort of straddles both sides really well. Obviously, has a crypto fund, so obviously he believes in it. But at the same time, he has the right level of skepticism that I think is very, very important when it comes to crypto. And he really kind of has a good sense of what the true value is. The other, I mean, I could go on and on, but I mean, just two other names I've mentioned is one is Alex Gravich. He's great on rates. He's good. He has a really good intuitive and theoretical understanding of rates, which is very good. Boris Vladimirov, I think I always really enjoy speaking to as well. He's currently at Goldman's. He has kind of an EM type background, but again, framework driven and very good. I could kind of go on. David Dredge was great. Todd Edgar was great. I would say pretty much, so many of the people we've had were really, really quite good. So, yeah.
No, that's awesome. And what are sort of the best lessons that you've learned in terms of investing in markets when it comes to when it comes to podcasting? So I guess the reason there's a reason we do podcasts is so that we can talk to smarter people and get their lessons and their ideas and their perspectives. So what would have been the best lessons or the best aha moments that you've had when you've spoken with all these people?
Yeah, I mean, I would say one thing that becomes very clear when you speak to sort of people is that very, very smart people can have very different views on the same subject. So you can get very smart people that will talk about how inflation is out of control, it will go very high. Then you'll have very smart people arguing the opposite. And the same on crypto, the same on equities will go up, equities will go down. And so what that tells you is that being smart in itself won't necessarily lead you to one answer. That in the end, when it comes to investing, nobody really knows the future. Who knows what's going to happen in the future? All we can do is we can have our best guess of what the future will be, and we need some mechanism to be able to revise our views when new information comes about, and know when to change that view. So one of the biggest lessons I have when I speak to people is just humility to, have this sense that no matter how much how smart I think I'm going to get, how experienced I'm going to get, I won't really know the answer. If anything, sometimes knowing too much, will give you, once you know, the more and more you know, the less certain you become. That's one thing that sort of almost kind of happens when I speak to people. The other thing that does come up a lot when I speak to people is a lot of people. One of the lessons I guess is sort of patience is very important. A lot of the people I speak to, one way or the other, are talking about patience, and I think in a world where we're inundated with information, it's very easy to trade very quickly. One can overtrade, and all the academic literature is very clear. Overtrading leads to poor returns. And I think one needs to be careful about confusing noise for signal. Just because some headline comes up and everybody else is doing something doesn't mean that anything's changed. So one is humility, the other is patience. And then a third, I would say, is kind of curiosity, that many of the people I've spoken to have a deep curiosity about why things work the way they do. They have a willingness to explore new areas of markets. Like some of the sort of top hedge funds I speak to, some of the founders of the biggest hedge funds in the world, I'm often surprised how willing they are to explore new asset classes, whether it's crypto or uranium and all these other sorts of markets. They have that willingness to go out of their comfort zones to learn about a new asset class. So humility, patience, and curiosity, I think, would be the three sort of lessons I've learned, from speaking to all of these great guests.
Yep, that's awesome. And so, to wrap up the podcast, I guess, if you could leave investors with 3 lessons, what would they be? I guess about markets, trading, or even, just general lessons that you've learned from your podcast.
Yeah. I mean, I would say that the first important thing about investing is don't get wiped out. So sometimes people focus so much on the positive side, the return side. I can make 1,000% or this and that and the other. But the first rule of investing is don't lose all your money, don't get wiped out. And while that may sound like obvious and simple, there's something behind that, which means that in order to not get wiped out, you have to make sure that your investments are such that a given market move isn't going to wipe out your wealth. So that tells you, okay, you have to understand the volatility of the asset class you're exposing yourself to. And here I'm thinking about crypto, where crypto is an 80% volatility market compared to equities, which is 20%. So equities already is quite volatile, but in Bitcoin or Ethereum or whichever market, you can get 4 or 5% swings every day. And if you don't size your position correctly, it could really put a massive dent in your personal wealth. So one of the most important things is make sure you don't get wiped out and you stay in the game. Because in the end, the way you make money in markets, which is the second thing, is through compounding returns over time. That's the way. So making small returns every single day for a long period of time, which compound over time. So so in order to do that, you have to still be in the game. If you're stopped out and you're out, you can't compound. So the second thing is always make sure that you're invested and you're compounding your returns over time. And then have a sense of what the long-term returns are that you're trying to capture. So what we know is equities tends to give you positive returns over time. Bonds also deliver some kind of return over time, and you generally want to lean to have those sorts of exposures. Right. So those are kind of the two kind of core principles. And then the third one, I think, which is very relevant for a year like now, is that sometimes it's fine to have some cash as well. That people often think cash doesn't have any value because you earn no yield from it. But I think cash, especially in a highly uncertain year, if you do have some additional money to invest, sometimes putting in cash is the best option, especially in an environment like we're in today, where it's unclear, how the world will unfold. There's potential lots of kind of exogenous shocks that could affect your portfolio. But if you have cash, you have to think of it as its optionality value, that if you have a large chunk of cash available, when market prices get distressed, when an asset gets distressed in price, you can come in and buy something at a distressed sort of value. So I would say don't underappreciate or don't undervalue cash.
Cash by itself is an active position, and I think people forget.
Exactly. Yeah.
And Alex Gurovich, talking about I guess market bubble, like asset bubbles versus cash bubbles, and so and describing March as a cash bubble. And so I think that's also an interesting framework to think.
Yeah, absolutely. Yeah.
Well, Bilal, thank you so much for being on the podcast. It's been awesome, getting your thoughts on various markets, talking through, what you've learned, in your journey of building MacroHive. So, thank you so much for being on the podcast. And if anyone's listening, if anyone's still listening, make sure to check out MacroHive. It's a phenomenal podcast. It has awesome guests, awesome interviewer as well. So, thank you so much for being on, Bilal.
No, my pleasure. Great to be on.